Ramez, and so they'll typically stay muted. And we'll have Q&A. We'll get to it on the back end from everyone, and then we have the entire community is going to be on Facebook, and we're streaming it, and that's how.
Absolutely. Sounds great.
So I have a format. I wanted to start off with kind of like, the why is it, why is it important for people to be able to self-direct? And then we could go into the differences and how they can set it up, and then and timelines and all of that. Checkbook LLC, if all of that works with you. And you could take it at any point and direct it, but that's what I had planned for it.
Yeah, please, just any question you have, just fire away and I'll give my answers, and I'll kind of bounce off of you a little bit to kind of help, you know,
Absolutely. Okay.
GW. I just don't want, like, I have to be very careful when I talk about alternative investments in companies and stuff of that nature.
No
As a
worries.
bank, as a self-directed company, there's a set of rules and regulations I have to follow.
Yeah, and I have your bio, and just remember, like the community is like we're like 20,000 physicians at this point, so it's just completely educational. That's the goal,
Yep.
and so we're just providing resources. We will on the back end share your IRA club's resources with them also, and
Awesome.
yeah,
Great.
you can stay. I would love you to stay as neutral as possible. Okay.
Thank you.
Adrian, let me know as soon as we're live and streaming. We may already be. This way I can just do a
We're all
quick
set.
tech check. Okay, perfect, perfect. Hi guys, hope everyone is having an awesome Thursday. I'm a little under the weather, so I am going to let me sipping on my tea in between. I'm super excited for today's conversation, though. Thank you so much, Ramez, for doing this. Quick tech check. Adrian, can everyone hear me okay can someone give me a thumbs up on Facebook if you're hearing us okay? As always, we're going to have tons of time for Q&A. So if you have questions, guys, you're listening to us on YouTube or Facebook, and for those of you on Zoom who are in our coaching program, just keep dropping your questions into Q&A. Do you have a hard stop, Ramez, on the back end?
Nope. I'm here as long as you need me.
Okay, so hopefully we can wrap this up by 6, but we'll try to get to as many questions as possible. Any of you listening to this on replay, please drop a hashtag replay into the comments in Facebook. This way the algorithm bumps things up. But that being said, I am super excited to get started. Okay. Hey, Zach. Hi, Farshid, Rachel. Nice to see you guys on here. Okay. So today's episode, I think, is something a lot of times I have a lot of clarity about topics. I'm hoping to learn a lot today from you, Ramez, but this is for those of you who are looking at your retirement accounts, and I've heard this so much in conversation with other physicians, and you're worried that your retirement account isn't growing as fast as you thought it would be growing, or if you want to invest in real estate, you've been listening to us for a while, but you're frustrated because you really have no capital in your savings accounts to invest in real estate, but you still want to tap into the higher returns, diversification, and tax efficiencies that real estate affords. You want more resilience and stability in your portfolio, and you don't know what you should be doing, then this is the episode for you. I would say about 30% of our investors use, their retirement accounts to invest in real estate. So I'm very excited to deep dive into this for those of you for whom this may be a new concept. Ramez Fakhoury is from the IRA Club. And Ramez, you can correct me if these numbers are incorrect, but what I heard is that we have about 14.6 trillion, in IRAs across the country, but only 4% of people use the money to invest out of the stock market. Like I said, again, the reason people want to invest in real estate is because they want tax efficient, higher returns. They want to reduce portfolio volatility, and all of that is going to get them to retire faster with more money in their retirement nest egg. And so I have with me Ramez, who is VP of the IRA Club. He's an entrepreneur and an educator at heart with over 2 decades of experience in the hospitality sector, financial services, and real estate. So I think you're perfectly positioned to educate us on this. He's committed to educating investors so they can reclaim control over their retirement accounts and accelerate to financial independence, which is what we're all about. And thank you so much for doing this, Ramez.
Absolutely, absolutely. And you are correct, by the way, a little over 14 trillion just within one type of retirement account, which is IRAs. But when you use all qualified retirement accounts, Some of you that are listening have 401ks, 403bs, 457s, some maybe in the military with a TSP. So when you collectively put all the wealth of America, I hate to say this, sits within retirement accounts sitting at $45 trillion.
Oh, wow.
And
Okay.
only 3% is self-directed, 4% within IRAs.
Yeah, and the challenge for us is, we're talking to members in our community who really want to start investing, but the bulk of their capital is locked within retirement accounts. And my passion is about asset allocation, right? Because if you're at this optimal asset allocation, then your portfolio returns are boosted, you're getting to financial freedom faster. But if the bulk of your money, your savings is in your retirement accounts, and you only have the option to invest that in the stock market, and that's really weighing your portfolio down. So let's start off by, the first question is, in your opinion, Ramez, what is the power of self-direction? Why do people need to start, having the option to self-direct the retirement accounts?
So let's be clear about the word self-direction. Let's start off with that, Priyam. In me, there's this big misconception, but self-direction in our industry just stands for control, right? We're trying to get our, your group of students, investors, our 15,000 plus IRA club members to think about, think outside the box, to be clear. So self-direction just allows you to take a portion of your retirement dollars. Not that we have a problem with the stock market. We
Yes.
just look at it in a different facet, right? We talk and preach diversification because at the end of the day, you don't want to just diversify your retirement dollar. I'm sorry, your personal dollars, but you want to retire your retirement dollars. What most people don't understand is when you utilize retirement dollars, you accelerate ROI growth. It gives you more flexibility into control, lets you invest in what you know and understand best. And I just personally believe not all of your retirement dollars should just sit inside one egg bag. Like, you've got to think, real estate, land syndications, private equity deals, anything that your heart desires. It's just one thing that we can't do in the self-directed world is we could never choose the investment for the investor. So when you think of self-direction, just think control. You're in control. We will facilitate that for you.
Awesome. And again, an important point you made is a portion of your retirement account. So you don't need to take everything and move it into your self-directed. You still have the ability to move a small portion of it. And again, like Ramez said, you have control. What assets do you want to invest in? How much do you want to move? And so there's still a lot of control over there.
Correct.
Ramez, you and I have talked about this quite a bit, and there are so many different ways, different vehicles, and I believe the IRA Club works, with investors who want to invest either through a self-directed IRA or a solo 401k. So there are options for people who want to, diversify within their retirement account. So can we talk about those different options and the pros and cons, maybe, of what those would be?
Yeah. So let's this is Prim.
If you
This is
need to keep
hilarious.
backing off, just keep backing.
No. So that's why I'm laughing. So most people don't realize this, but all retirement accounts are self-directed, right? You have the ability, but you just don't realize that this is an option. So the IRS tax code, when it was written back in 1974, never told you what you could and could not invest in. It was kind of hijacked, to be honest with you.
Mhm.
And I was like referring to the big three, which is Fidelity, Vanguard, and Schwab. And I'm almost guaranteeing that
Yeah.
70% of you that are listening to this right now have an account with one of those three. I'm almost guarantee it because we see thousands of transactions. And you're laughing, Priyam, because you're raising your hand. And I'll be frank with you, I'm one of them too. I do have a Vanguard account also, but that's to do options trading and whatnot. So it's, again, we're not against the stock market, but where do you lose the control? And most of you don't realize this. It's when you have an employer's retirement account. Again, a 401k, 403b, 457, you give up that aspect because it's tied into your employer plan. Okay. So when you lose that, that is where we come in and educate you. What are the other options that are out there? Okay. And the only thing, again, is we're giving you the control. Let me backtrack a split second and say, you talked about different types of retirement accounts. There are so many that are out there, but most people do not know this, Priyam. All retirement accounts stem from the IRA. Okay. So what does that mean? So think about this. When you have an employer's 401k, the only thing that you could do is keep it within the stock market. In particular, 83% of employer plans sit within mutual funds. because that is their definition of diversification, which is
Mhm.
large, mid, small, international stocks and bonds. That is not our definition of diversification. We just know how to utilize the stock market to our advantage, if that makes sense.
Mhm.
So again, all retirement accounts are self-directed unless it sits with your employer. That is the only time that you could not touch those funds. When you leave your employer, or you're furloughed, God forbid, or let go, or you decide you want to do a different career path, then after 30 days, you have access to those dollars. Then you could roll it over to the IRA club. And to be clear, I think, Priyam, I just want people to understand who is the IRA club, right? Many of you heard of a self-directed retirement account. So I apologize if this comes off as being a little bit redundant, but when you think of IRA club, I want you to think of Fidelity, Vanguard, and Schwab, right? The only difference is I let you do what you want. And also, you never trigger a taxable event. You're moving the money from one trustee to another trustee. Your money's FDIC insured at Fidelity, Vanguard, and Schwab, and the IRA club. So those are the things that people don't understand. Where the hiccup is the lack of education. The reasons why people don't self-direct: lack of education. They cannot identify the investment opportunity, and that's number one. Is you should identify the investment opportunity first before you open up a self-directed IRA account, because that's the easy part for IRA club. And lastly, it's because, again, I talked vaguely about it, but these artificial restrictions that you hear. And in particular, who are they coming from, Priyam, right? It's coming from the broker dealers, your fiduciaries, registered investment advisors. And not that we have a problem with fiduciaries and registered investment advisors, because they actually do utilize our services. It's because what they're saying to you, and even some of them have no idea what a self-directed retirement account is. They actually call us literally, if not every day, 5 times a day, asking us what makes you guys so different. But it's because even they're not educated in the
Correct.
asset or the facet of self-directing, right, Priyam? It's not
Yeah.
something we all went to school for, not something we ever learned in college or
Yeah.
high school. It's not even something, Priyam, when was the last time you sat down with your mother and father sitting at the dinner table and be like, hey, Dad, Mom, did you know that I could use my self-directed retirement account to diversify? Like, no, you can't do that. My broker told me I can't do that.
Right.
So it's just the lack of education is number one. And this makes me laugh every time I hear this, Priyam. I'm too old to get started in the self-directed world, right?
We hear that in the real estate world too, right?
Like, why? When are you ever too old to tell Uncle Sam to don't laugh, kick rocks, or get out of my pocket? So you're never too old. The average American lives until just under 80 years old. So this is how you generate generational wealth. This is how you accelerate it. And when you accelerate it within an IRA or 401k, you don't pay taxes. They're either tax deferred or tax free if you have a Roth, right? So
Mhm.
you got to be thinking about those things, because if you keep your entire 401k in the stock market, when you look at things, Priyam, decade by decade, what is the average rate of return in the stock market inside your 401k? It's roughly about 7 to 8%. You got to think, this day and age, how safe is your retirement? Everything's working against it right now, right? Volatility of the markets, even though, the election has passed us, there was a huge boom in the market,
Yeah.
right? We know that taxes will never be cheaper than where they're at right now. We have a progressive tax system here in the US.
Yeah.
Inflation, I hate to say this, I don't know, although trending in the right direction, I still feel it when I still go, to the grocery store, when I'm going to, traveling from event to event. Everything is up. I don't care what anybody says to me, right? And then lastly, pensions are no longer being offered, right? Less and
Yeah.
less companies. I think it's less than 4.5%. And not to mention, Priyam, every single government program is in shambles, from Medicare to Social Security. So you have to think about these things. I don't care how old you are. It has to, and you got to think double digit returns. You can't be dependent on the 7 to 8% anymore. Otherwise, Priyam, you know this and I know this. You're going to work for the rest of your life if you don't start diversifying into different asset classes.
Absolutely. And a large part of what you said, the volatility in the stock market, there's the
Mhm.
sequence of return risk, which is exactly what you said. And we saw this, I had my attendings in 07, 08 when the stock market crashed. People who wanted to retire had to keep working for another 5, 6 years before they were even able to do it, right? And that's what happens when you're entirely within the stock market. And something that you mentioned, which was I guess it's something never registered for me before, is the fact that in order to invest in a self-directed IRA, you need to identify your investment opportunities first, which is probably why when we send a lot of our investors your way, when they
Mhm.
want to use their self-directed IRA, they already have investment options ready. And so for anyone listening, if you go to gwcapital.com, you have the ability to book a call with us and learn about our most recent opportunities. We constantly have something that's either cooking or in place. And so that's a very valid point. Is it true, Ramez, that over the age of 59, you can transfer current employer funds into your self-directed IRA?
Actually, good for you. Most people don't know that, but where the limitations fall, you cannot touch your employer 401k. If you were to, so let's say, for example, go talk to your HR department, there are a couple loopholes. One of them is if you're over the age of 59 and a half, about 85% of the time, you could walk, again, make sure you walk up to your HR department. I'm not telling you to do this. That's step number one. And just ask the question.
Hmm.
Because now legally, without a penalty, you're allowed to touch it or take out a distribution.
Hmm.
What you may not know is you could roll over to the IRA club what you have contributed to your 401k throughout the years. However, you will not be able to roll over your capital gains or what your company has matched. So if you have a 3% match, 4%, 5% match, you will not be able to roll that over. But starts with ask the question. If you don't ask, you don't know.
Awesome. And then this is something I learned when I was speaking to you a few days ago. You're able to roll over into a self-directed IRA funds from a Roth IRA, a SEP IRA, a self-directed HSA. Am I correct in saying that?
So you're again, all retirement accounts again are self-directed. Okay. To be clear, federal. So a lot of you guys will call me up and say, I have a 529 plan for my child. Okay. That is a state plan. That is not self-directed. But
Hmm.
however, because of the Secured Act 2.0, for the first time ever, starting this coming year, 2025, a state plan and a federal plan will coincide with each other. How so? You will be able now to open up a Roth IRA for your child if you do have a 529 plan, and you will be able to roll over up to $7,000 in the name of your, the IRA. The Roth IRA has to be still titled in the name of whoever has the 529 plan, but you could do that each year up to $35,000. And now that money can be self-directed. That is the only time you could self-direct a 529 plan. But back to your question about the HSA, because I was trying to get off, I went off in
Well,
a
that
little
is
bit of
actually super exciting because now you're saying that 529 plans under with you may be able to roll them into a Roth IRA for your child.
starting next year, starting 2025. So Secured Act 2.0, I know no one's ever read it. Okay. I have a whole compliance team. It's like 900 pages. But of those 900 pages, a little under 400, believe it or not, really focus on retirement accounts. And it heavily, heavily favors the Roth. There are way more positives about these 90 new provisions than negatives. Okay. Because you're really trying to help people tuck away money inside these retirement accounts. One of them is going to be, depending on what state you live in, it's already happening. You can actually, I'm sorry, your employer has to offer some sort of a retirement account, whether it's a 401k or payroll deduction IRA. So it's going to happen whether you like it or not, if you're an employer. Okay. The point I'm trying to make is look at these 90 new provisions, 26 of them of the 90 favor Roth. So every single buddy starting next year, if you're getting a contribution, I'm sorry, an employer match, please forgive me, Priyam, make sure to go to your HR department and you could now ask for that employer match to be done within a Roth basis. So
Hmm.
if you're getting a 3% match, a 5% match, they're typically doing it right now in the traditional sense, a
Right.
traditional 401k. Now you could go ask for it to be done in a Roth starting next year.
Wow, that's super
Yes.
powerful. Okay.
So, and again, often a tangent, but you were referring to the HSA. If you do have an employer's HSA, you don't have to wait to move those funds over to the IRA club. Those could actually be done tomorrow. So keep that in mind. Most people don't know that, but HSAs can be self-directed. The problem is they're I hate to say this, the limitations on them and the contribution limits are a lot less than an IRA, and even a lot less than a 401k, because we all know that we could contribute up to 23,000. And by the way, next year they bumped it an additional $500, Priam. I don't know if you know that. So yes, so now your 401k could be 23,500, but still you cannot touch your employer's 401k. With your HSA. Yes, you can roll that over to the IRA club, and yes, it can be self-directed. Now, many of you, Priam, that are listening probably don't have much inside of your HSAs, but maybe me and you could talk about the topic of partnering.
Mhm.
Partnering is such a powerful strategy too.
Yeah, yeah. So many valid points. And so I feel like we've touched upon, for those of you sitting there thinking, well, I don't have a lot of capital to invest in real estate. I think Ramez talked about, funds from your HSA, old employer 401s, Roth IRAs, IRA funds, anything that you could potentially roll over and use to invest in real estate. Now, we always have investors. I mean, we have a deal right now in Houston, amazing deal, 85% tax exemption. We have so many people who want to invest, but they now want to tap into their retirement accounts.
Mhm.
And if someone is in that position, okay, they have the funds, they want to tap into it. Now there are two, and suppose they have a small business, right? Now there are two options for them. They could either do a solo 401 and invest in real estate through that, or they could do it through a self-directed IRA. Can we talk a little bit about those two options, what the differences are in terms of fees and taxation, and what would make sense for people?
Oh, absolutely. So if you are a small business owner and you're self-employed, right? So what does that constitute? You have to be the sole proprietor of an LLC, C Corp, or S Corp. That's the only way you qualify for a solo 401k. So Priyam, you had a long conversation about that because you had a potential investor and they were self-employed, but they actually weren't a good fit for the solo 401k.
Okay.
And the reasons why that is. So, number one, in order to contribute to any qualified retirement account, you have to have earned income.
Hmm.
This person just opened up a solo 401k,
Hmm.
but did not have any earned income. It wasn't profitable yet.
And the
So
earned
I
income has to be from that business.
from the business.
Okay.
Okay. So the way that it would work, let's say for the solo 401k, is let's just say hypothetical scenario, you made $200,000, okay,
Hmm.
within the whatever the C Corp, S Corp, or LLC. You can pay yourself, okay, up to $23,000 for this year. And then
Hmm.
we could set up a profit sharing plan so you could contribute an additional 25% of your net earnings up to $69,000. Okay. That is why the solo 401k is more powerful than the IRA. The
Hmm.
other reason why the solo 401k is more powerful than the IRA, which we never recommend that you do, but you could borrow up to $50,000 at prime. So you have
Hmm.
5 years to pay that back. All right. Or otherwise, it's considered to be a distribution. The other reason why the solo 401k is more powerful is you could leverage against it without triggering something called UBIT or
Hmm.
UDFI, unrelated debt financed income. So these are the reasons
And
why
for
the
real
IRA.
estate investors, that does come into play because a lot of us use leverage in our deals if they're active or passive investments.
Yeah, but the only issue, Priam, is less than 9% of Americans qualify for a solo
Absolutely.
401k and or SEP, which is a simplified employee
Hmm.
pension. So, and the other thing that to keep in mind, the solo 401k is more expensive for a lot of reasons.
Yes.
It is a lot harder to administer. So the solo 401k has 200 plus pages worth of rules and regulations,
Hmm.
and the IRA only has 9 pages worth of rules and regulations that we have to follow. The solo 401k costs $395 per year to administer versus
Hmm.
the IRA costs $195 to
Hmm.
administer, right? But the other
Hmm.
thing to take into consideration is you also have to establish an LLC within the solo 401k when you want to invest in real estate. The IRA, you don't have to establish an LLC because your IRA is a trust. It's a separate entity from who you are. So the IRA will protect the asset. So that's another reason why it's more expensive. Again, more powerful. So how are you utilizing these tools? What are your goals? What are you trying to accomplish? Will determine how IRA Club will present different
Different
options to you.
options. So the solo 401, the earned income has to be from that business, and you aren't in a position to roll over anything into the solo 401. It has to be earned
Nope.
income from.
You can roll over. So if you qualify for a solo 401k, you can roll over funds from an old employer 401k to a solo 401k. It's okay to do so.
Do you need to have certain income minimums to meet within that business to qualify for a solo 401?
Nope.
Okay,
Nope.
but as long as you have a valid business that qualifies you for a solo 401, I think it has an employee limit and different things like that. As long as that is met, then you can open it up and you will be able to roll things over, but it's more expensive from an administrative perspective.
It is more expensive. And for the first time ever, we're the first self-directed IRA company, which I'm very excited about to say this. We now offer safe harbor 401ks, Priam. So if you do, or if you are listening and you do have employees and you want to get in the self-directed world, we can establish a safe harbor 401k for you and your employees. Okay.
Mhm.
And in turn, so a lot of, the question always comes up, I want to self-direct, but I have employees. Well, we have an
Mhm.
option for you now. That's a whole nother topic of discussion. But if you ever wanted to learn, you could visit iraclub.com
Oh,
and
that's
we could get
amazing.
into that. That's just like a whole nother topic.
Yeah, that's okay. That's amazing. Let's talk a little bit about UBIT taxes because a lot of our investors into syndications where leverage is being used. And what are the implications for that, Ramez, in terms of someone just give us some numbers to understand how that works. On the back end, what would that look like if someone invests, say, 100,000 in a syndication and they double their capital in, say, 5 years, but they've used
So,
leverage to acquire the asset?
so great question, Priyam. UBIT and UDFI is such a sticky subject. Okay. Um, and you just gave the example of a syndication. Okay.
Mhm.
So if there is a one-off syndication, right? So there's a 506C maybe structure or 506B, and at that 506B, there's only one asset, which is that syndication. And there's leverage against the syndication. So let's just say, Priyam, you use the example of $100,000 syndication. I'm so sorry. Let's just say it's $1 million syndication. I'm going to
Mhm.
keep it real easy math.
Mhm.
You put 20% down, okay? Now, if we just say the 1% rule, you're giving somebody $10,000 back, okay? And they use their IRA to invest that 100,000.
Mhm.
That would mean that $8,000 would be subject to UBIT. So 2,000, because 20% of 10K, right,
Mhm.
is, let's just say this is the dividend that you guys are giving.
Mhm.
2,000 of it would not be subject to UBIT because 20% 80% has been leveraged. I'm sorry, it's been a while. I've been talking for a long time today. So 80% now would be subject to UBIT. So let's say that $800 would qualify for that, it would hit that UBIT tax.
Mhm.
All right. So the UBIT tax could be quite hefty, to be honest with you. And it is a tiered structure. So, for example, from 0 to, I believe, like $4,000, you would be subject to an additional 12%
Mhm.
UBIT tax. And it goes as high as 37%. And
Mhm.
that number is, once you hit over 12,300 and some odd dollars, you would have to pay a 30%, 37% tax on anything over 12,000 and some change. So you got to keep that into consideration. Again, ways to avoid UBIT is the 401k that we just talked about,
Mhm.
or Priam, if the structure of the fund is kind of like an evergreen fund, or if it's a diversified fund, right?
Mhm.
That, so you're investing, like, say, that $100,000 from your 40 IRA into the fund, and then the fund is deploying the cash to whatever asset classes. It could be, again, a multiplex unit, a commercial property, land, whatever it is. Now that is offsetting UBIT.
Mhm. Now, there's another tax implication. Like, if I were to invest in a syndication outside of my retirement account, and I have an exit, now I'm traditionally I want a 1031 into the next deal because I'm
Mhm.
subject to capital gains and
Right.
depreciation, recapture, all of that. How does
Mhm.
that work within a self-directed IRA? Someone gets into a syndication and exits. What happens to all those tax implications?
Well, first of all, if there is no leverage, all of that money would go back to the IRA tax free or tax deferred. So if you have a traditional, it's tax deferred, so you don't pay any taxes on that.
Hmm.
That's how you accelerate it into the next deal or pick the next deal, right? With the 1031 exchange, we have a certain time limit. We got to
Right,
go find that next deal. With a retirement account, there is no time. It's whenever you're ready to make that next investment opportunity. Okay.
right.
That is when we tell our clients, our IRA club members, don't let the money sit. You could throw it inside our, this Priam, we have a trading platform
Hmm.
or our AI smart folios. So the money's constantly working for you
Right.
until you find that next deal. But there are no taxes that you would pay on the capital gains.
And it's very flexible because if you're investing outside of your retirement accounts in syndications, 1031ing on the back end, you
Mhm.
need the entire LLC that owns the current asset 1031. So you're limited to 1031ing with the same sponsors as though there are those timeline restrictions, but within the self-directed IRA, you have so much more flexibility. You get to sit and then wait and make those decisions. So that's super powerful. Okay, so now let's talk about so someone now people are getting creative. They have all this capital they have in their retirement accounts, and now they know what their options are. Now, even within self-directed IRAs, I'm sure you do this time and again for a lot of people. There's so many different ways for people to invest in real estate. Some people probably prefer to be on the lending side and they lend notes. Some of them invest passively in syndications, and some of them actually do direct ownership of real estate. So, do you want to touch upon that and the patterns you see, or what, and just elaborate on the options people have even
It's so
within.
funny. It's so funny, Priyam, because one of the most powerful advantages that I have here at the IRA Club is I could see how our members are investing. Okay.
Yes, yes.
There's kind of like a pattern. When I say pattern, like, pre-pandemic, it's always been real estate, right? The well was drying up. It was getting harder to find deals.
Mhm.
Real estate skyrocketed. And then at one point it was crypto. There was a crypto craze and everybody was taking their retirement funds and throwing it into crypto. And then private equity deals and syndications blew up, right? So we could see this pattern. And right now, lending and I will tell you has been huge, and what our investments team sees. But
Yes.
with lending, just be careful who you're lending to. We catch a lot of prohibited transactions. You think that you could go, and when I talk about prohibited transactions, there's certain people that you could not lend to.
Yeah.
And those people are, just think of a linear ladder, or your lineage. Just think of a linear ladder. So the people that you could not lend to is going to be me, my spouse, my children, my grandchildren, my parents. So we're catching a lot of people trying to lend to their children. Okay. And you
Mhm.
cannot do that. However, can you lend to your best friends? Can you lend to anybody else outside of it? Yes, you can. But when you lend, we're very clear. You make sure that there's an asset tied into that, whatever that money you're giving up. Because remember, retirement dollars are the most precious type of dollars to you because this is kind of your nest egg. So you have to
Mhm.
be careful. Make sure you perform your due diligence before you do anything. And then the concept of lending, we tend to tell people there's only so many times that you could lend within 1 year, okay? Because you can trigger off an audit.
Mhm.
So we try to tell people be careful. Just like fix and flips, for example, Priam, we tell people you're only allowed to do 2 to 3 fix and flips within your retirement account because then that sets off a red flag. All
Okay.
right. So same concept. And then lastly, leveraging. Just be careful when you do leverage. Make sure the reason why I bring this to your attention is leverage has become very big in the self-directed world. 99.9% of banks do not like to leverage against retirement accounts. It has to be structured as a non-recourse loan.
Mhm.
There are obviously companies that we personally deal with that we could obviously introduce anybody to, but
Right.
be careful because the interest rates are typically 2 to 3 points higher. I think right now, what is it at 6.5, 7%?
Commercials even closer to 5% at this point.
So 2 to 3% on top of that is what banks are typically asking for. And they want 50, 60, even sometimes 70% down. So be
Higher equity.
careful. Yeah, just be careful when it is when you're leveraging. And you might trigger UBIT too. So be careful of that.
Yeah, those are very, very valid points because we have a lot of people who are active real estate investors. And so I'm sure those are points that are very valuable to them. And something you said, Ramez, just made me smile because typically when we are at the riskiest part of the market cycle, at the peak of the cycle, which was March 2022, everyone's seeing all these returns from real estate and everyone wants to be on the equity side, which
Yep.
again, that is the riskiest time to be on the equity side. And right now we're at the bottom of the market cycle, trending back up. Everyone's thinking lending because it feels safer, but this is probably in my perspective, the time to be on the equity side because you have those opportunities and the market is de-risked inherently. So interesting points, but what we would typically expect from a market psychology perspective. Ramesh, tell us about how depreciation is handled within an IRA. Now, outside of an IRA, outside of retirement accounts, someone gets depreciation, their cash flow is considered, it's tax-free. How does depreciation play into UBIT calculations? Does that get factored in at all?
No, it does not. So depreciation, a lot of people come up and ask me, well, I was told by my CPA not to use my retirement accounts because then I lose the depreciation aspect of it. Well, I kind of look at people and I say, okay, and for example, a Roth, you're not paying the taxes anyways. There is no taxes. Again, we're talking about diversification. So you
Correct.
can't double dip. You
Right.
can't get the depreciation and get the tax advantages of a retirement account. But
Yes.
what I try to explain to people when you think again, Priam, decade by decade, because you can't touch that money anyways until you're 60 years old,
Yeah.
right? 59 and a half. So I tell people when you look at things decade by decade, let's say for the last 20 years, if you have an
Mhm.
employer's 401k, the S&P 500 has given you back 326% returns on your money. When you look at real estate, and we're talking about compounding, by the way, right?
Mhm.
Whether it's private equity deals, hard assets, commercial, whatever it is, it's 2,100%.
Mhm.
It's not even close, is what I'm trying to explain to people.
Yeah.
So don't you think it's just as important to diversify a portion of your retirement dollars
Yeah.
into it far exceeds it. So when I tell people when you talk about depreciation, yes, use your personal dollars for that, no
Yeah.
problem, but take a portion of your retirement dollars and think alternatives at the end of the day.
Absolutely, especially because the bulk of most people's wealth is sitting in those retirement accounts. If you're diversifying what's outside of that, and you getting to like a 40 or 50% asset allocation in alternatives and you're not touching your retirement account, so then you over across your entire portfolio, you're not at a 30 or 40 or 50% diversification. So makes absolute sense.
Yeah.
Let's shift to more actionable steps. So now, I think we walk people through, okay, why should I even be doing this? Where can I get the funds from? How can I invest within the IRA? Let's move to, I want to touch upon, say, timelines. If someone is considering, okay, they have an investment opportunity, they've identified it, and now they want to tap into the power of the self-directed IRA. When they are referred to, say, the IRA club, how long does it take typically for funds to be transferred over from their current custodians, if it's a previous employer's 401, and how long does it take on average to deploy that capital?
That is such a tricky question, and I'll tell you why. So, and you know this because you're smiling, but see, the process of opening up a retirement account here at the IRA Club literally would take you 8 to 10 minutes, right?
Yeah, yeah,
My recommendation would always be sit down, talk to somebody from our onboarding team. Most people that we talk to don't even realize what they have, what they don't have. What are you trying to do? What type of retirement account is best suited for you, right? We always want
yeah.
to have that conversation first. Opening up the account is easy. Takes 8 to 10 minutes. All we're going to ask you to have is your driver's license or government issued ID like a passport or
Yeah.
state ID. Your beneficiaries information, God forbid something happens to you during this process. Always good to name a beneficiary, okay? Your social security number, because everybody needs a social security number to open up a retirement account. And lastly, your most recent statement will really accelerate the process, okay?
Hmm.
But the answer to your question when it comes to funding, right? There's only three ways that you could fund a retirement account. That's a contribution, right? So I
Hmm.
mentioned 7,000 or 8,000 if you're over the age of 50 within an IRA. 401ks, I already told you what that is, which is 23,000, or $30,500 this year, okay, within your
Mm-hmm.
401k. And you could either do an IRA to IRA transfer, if you were, like, say, with Fidelity, Vanguard, Schwab, or one of the other 10,000 brokerage firms or the administrators that are out there.
Mm-hmm.
Or when you leave your employer, like we talked about earlier, then you could do a rollover. And by the
Mm-hmm.
way, you're only allowed one rollover per year, only one. So
Mm-hmm.
be careful. If you're trying to do a self-directed retirement account and you want to do a rollover, and let's just say, for example, Priyam, you just said to your client, hey, the it's $100,000 minimum investment, and you send over 90, you just lost it. So now you got to figure out different ways on either whether you want a partner to get into the deal. So just be careful. One rollover per year, okay? And it all depends on which custodian it's coming from, your current custodian. Now, I will tell you, Fidelity, Vanguard, they move very quickly, okay?
Mm-hmm.
Charles Schwab, I'm just talking about the big three, not so much, okay?
Okay.
And you also gotta, it also depends on, like, if you need a medallion stamp, or, are we changing over assets? One thing, Priyam, that I not sure if even you know this, but we do have an ACAT system.
Mm-hmm.
And for those of you that don't know what an ACAT is, many of us know what a wire transfer, or an ACH, which is the movement of funds. And ACATS is not only the movement of funds, but the movement of securities. So we could literally move over the entire account over to the IRA club if you want us to go that route. Now, I'll never tell anybody sell off all your stocks, but we could move over Amazon stock, Apple, whatever it is that you want, over to the IRA club, because we do have a trading platform. And then lastly, invest, right? That's the last step that I can't do for you. So I never tell people, Priyam, don't ever worry about step number one and step number two, because that's easy for us. And the average time frame, beginning to end, for opening and funding could take anywhere between 4 to 10 business days, depending on what
Mm-hmm.
custodian is. But once the funds are here, Priyam, you know this firsthand because you do have a lot of clients that utilize IRA Club.
Yeah.
How fast is that? Once the funds are here, how fast do they get deployed? Right. I mean, it's very fast.
Yes. Absolutely. And so when you said one rollover per year, now it's for some reason that has never really completely registered with us, because we have people who want to get into our last Dallas deal and then the Houston deal, and they're trying to fund both, but then that rollover has to happen simultaneously. So everything. And so is that by calendar year, or is that a 12-month period?
Great question. Calendar year. So you could
Okay.
do a rollover right now, and then January 1st, do another one.
Okay, makes a lot of sense. So, because I know for a fact that a few of our investors who are getting into the Dallas deal and also who've committed for the Dallas deal, we're waiting for those IRA funds, are also getting into Houston. I know for a fact that most of them are combining that capital and rolling it over.
Yeah.
So, and for those of
But
you,
yeah, I'm sorry, Prima, I didn't mean to- but IRA to IRA transfers as many times as you want. It could
I
go
see.
as many,
Okay, got it. So the restriction
only
is only
401ks.
Only 401ks. Okay, perfect. So I'm pretty confident they're doing it IRA to IRA. Okay,
Yeah,
that's
as many.
very, very helpful. And so for anyone listening, and you're looking for an opportunity, and want to get in before the end of the year, our Houston deal, we are at the point where we probably have a little over 2 weeks to get funds in for that funding deadline. And so if you are considering using retirement accounts, then you would need to get the ball rolling quickly. And so again, those timelines start becoming important, especially if you're looking at, say, passive investments like syndications, where you have those defined timelines. I know when we work with the IRA Club, we have a unique relationship with them where the first year fees get waived for our community members, right, Ramez?
Yeah, so I'm happy. Listen, I love the fact that we're talking about fees. I want people to understand the difference between flat fee models and percentage-based models.
Correct. Hmm.
Yeah, I mean, this is a huge, huge drain on your retirement account.
Yeah.
And in particular, these are numbers that you need to be Googling and needing to be asking your HR department. Okay, this is very important. The average 401k across our country is about 2.25%. Okay. Think about that. For every $100,000 that you have, that's $2,000 that they're taking from you per $100,000, versus the IRA Club believes in flat fees. For us, it's $195 for the membership. Okay. The membership, that means to open up the account, for us to be the administrator. The way we make our money, because the next question is, wait, how are you only charging $195 premium? How do you guys make money? It's per investment is an additional 195. So per asset class. So if you want to do a house on 123 Green Street, it's 195. If you want to
Mm-hmm.
invest in, GW Capital, it's 195. You want to do an oil and gas deal, 195. The only asset class that we don't charge for premium, which I don't know if you know this or not, is to use our trading platform. We don't charge a penny to use our trading platform, meaning IRA Club. And that's, again, another topic of discussion. But to all GW capital investors, free the first year, meaning your membership. So we waive the 195. And we don't
Right.
care, by the way, Priyam, and you know this, if you have 10,000, 100,000, or 10 million, the most IRA Club could ever take from you is $195. Okay. Versus when you have a 401k or IRA with Fidelity, Vanguard, and Schwab, the only time that you get paid is when the market is up. If the
Yeah.
market is flat or down, are they still taking their 1 to 3%, whatever that is? Of course they are,
Yes.
especially if you are using a fiduciary registered investment advisor. It doesn't matter. They're still
Yeah,
taking their.
absolutely, guys. And I've listened to so many other, had conversations with other IRA custodians for self-directed IRAs, and I believe it's a percentage, right? It's anywhere from 1 to 2% is what I've heard. Maybe slightly under 1% is the lowest I've heard in terms of the fees that they charge. And so, if you're going into deal,
Are you referring, Priyam, to our industry?
no, to the industry, yes, to the
Yeah.
industry.
So I'm so happy you said that. So yes, please be careful. Make sure you're doing your background checks. We are one of the, I'm not saying we're the lowest of the low, not for the type of customer service that we offer, but we're definitely on the third half bottom. But many of by the way, Priyam, you know this, I'll never badmouth my industry because at the end of the day, we're all educators. It's like, where's your comfort level?
Yeah,
What do you guys offer? How do we walk you through this process? You know this, Priyam. We're not a call center. You call, you get the receptionist, you ask to speak to your client care representative. If you don't know what to do, like if you think you're causing a prohibited transaction, you call. That's
yeah,
very important. I don't know what form to fill out next. You call. We will
exactly.
literally pre-fill everything out to you and just send it to you via hello sign off, and that's how it works. But back to my industry, they're all shifting over to that percentage-based model. You
Yes.
need to be careful because that doesn't make us any better than Fidelity, Vanguard, or Schwab at that point. So,
Yeah, and and then those can be a huge drain on your portfolio over time. So it's very important to be cognizant of that. And
mhm.
we are dropping that link in the podcast notes, YouTube notes. But if you want to talk about how people can get in touch with you, Ramez, that would be helpful also.
IRAclub.com. I mean, it's a huge resource center. My recommendation would be on the top right side. Priyam, you know her very well. Mandy Drysdale. She has a team of 5 that literally all they're doing is they're onboarding people and ensuring that we're
Yeah,
doing everything the right way from you from the get-go. And then you get introduced to your IRA club representative, and that's it. And then I promise you guys this. This is my promise to you. Don't ever worry about the process. The opening and funding, easy. I promise you this. The challenge is identifying the investment opportunity. And that's why, Priyam, I love that you do these type of, podcasts, webinars, and you're constantly educating people. That's it. Once you have identified the investment opportunity, the rest is easy. Okay. And we do get a lot of people, Priyam, that ask us, by the way, we didn't talk about it, checkbook control.
yes, I was going to, and I was like, maybe this is too much information
Yeah,
for
yeah, it's a
people.
lot of information. Yeah, well, we could keep going and going, but yeah, you know what? Don't yes, we offer checkbook IRA LLCs, checkbook IRA 401ks. Just be careful. We are not the administrator anymore. You are the administrator. Very easy to do this process too. We establish the LLC on your behalf, whatever state you want to choose. We open up the IRA. We move the money from the IRA to your LLC. We'll also open up your bank account with our bank, okay, which is Meridian, and we literally just give you the keys. The problem is, Priyam, how many people do you think screw them up? And it's not that they're doing it deliberately, is what I'm saying.
Yeah.
It's just they don't realize that a rule or something has changed. And just keep in mind, I hate to say this, we make a lot more money off the checkbook IRA LLCs.
Yeah.
Okay. They're like $1,400 versus $195. And I sometimes tell people it's not worth it. It just let us do our job for you.
Yeah.
But at the end of the day, within a 5 to 10 minute conversation with Mandy Drysdale and her team, they'll know if you qualify for a 401k. And Priyam, I want to be honest with you. We don't like if somebody doesn't qualify, we'll tell them. We'll do it if they're
Yeah.
insistent on it. We'll do it, but we try to talk them out of it.
Yeah, and that's the important thing, and that's what's helpful because you're an educator at heart. You want people to do things compliantly, and you want
Oh, yeah.
it to be a good fit for them in the long run. So, as we're wrapping this up, guys, I guess I want to bring it back to what you just said, Ramez, which is essentially what I talk about a lot. Also, you said, a 326% return in the stock market across a certain time frame versus 2100. That's a 2100% in real estate. That's a 7x return from real estate, which is exactly what I talk about, right? And so if you want to get those higher returns, and we do a lot of the due diligence for all of our deals. A big part of what we're doing is de-risking those deals, and it's not just the higher returns, but simultaneously lowering the risk in your portfolio, which you're doing with diversification, but also when you pick the right deals, and that's what we're doing when you invest with us in GW Capital. And if you're looking to learn about our latest deals, go to gwcapital.com. That's essentially what we're doing, right? We're getting those higher returns, getting you to financial freedom faster. And if you're only doing that outside of your retirement accounts and you're not tapping into the bulk of your retirement nest egg to diversify and shift your asset allocation, then you're doing yourself a disservice. Thank you so much, Ramez. This was so educational, even for me. I never learn so much when I do these podcasts, and I had so much fun doing this with you.
Awesome. Thanks, Priyam.
I'm going to go into Q&A, Ramez. We
Oh,
have a few
please.
questions. And then,
Yeah,
guys,
yeah, please.
those of you who are on here, I think we'll still wrap it up at the top of the hour, so we should be okay. If you guys want to raise your hand if you have any specific questions. But I think the first one you already answered. IRA Club does also support solo 401ks. Are there any fees when this is Suman, who is actually working with you guys, I believe. He is trying to get into the Houston deal. Are there any fees when we get distributions back to the IRA Club from the syndication?
No, absolutely not.
Um,
Yeah, they go right back into your IRA, and then as the money just sits there, you could use our AI trading platform or pick your own stocks. So make sure the money is always working for you. Accelerate it.
and then withdrawals and distributions from the IRA to the individual, that follows the same rules like a traditional IRA, correct? There are
Uh,
no differences.
No differences. The only difference, so again, traditional or Roth, the only time they just mean two different tax IDs, right?
Mhm.
Traditional, you make the contribution, you take the deduction. Roth, which I'm a huge, again, advocate of, you make the contribution, you don't take the deduction, but for the rest of your life, it's tax free, and your spouse and your heirs.
Correct. And now, does UBIT applies to Roth IRAs also, Ramez?
Yeah, believe it or not, I
It
hate to
should, I
say
mean,
that.
technically speaking, it makes logical sense that it would. But again, you don't have any tax implications. Even when your heirs inherited, they don't have a tax implication with the
They
Roth
do
IRA.
not, but they have 10 years. So they
But
have
they have
10 years.
10 years to
They
do
have
to make distributions.
Yes. So if I pass it to my daughter, she's got 10 years.
Okay, perfect. And then I want to go back to the 529 and the Roth IRA if we have some time, because a lot of our investors, especially when they're investing actively in real estate, if they have older kids, they're paying them into their Roth IRA, which is something I love to do as opposed to using the 529. But if you have a ton of capital in your 529, you have the ability to shift that into a Roth IRA for your child. I think that's super powerful. But I think I'll just take a few more questions we have over here. So if you roll over our IRA or solo 401k funds to IRA Club, and then can we do our own real estate deals? I think Anjuman is talking about direct ownership of real estate.
Correct. Yes. So we actually manage about 4,300 homes here with IRAs or 401k dollars. And yes, our job, the only thing we recommend that you do is work with a property management company if you're going to do that, or because remember, it has to be hands off, keep it at arm's length. So when you do buy a property, for example, you can't fix it, you can't paint it, you can't do any of the work. You either have to hire a property management company, or in my case, I own a parking spots in my Roth IRA, and I have my sister who's a broker dealer, do all of the work for me.
Perfect. So that's again commingling of personal funds and IRA funds, paying yourself, having a short-term rental within the IRA, and then going and having personal stays. Those are all prohibited transactions.
Mm-hmm.
So another question Puvan has is, if I have an S corp running in losses, as a precedent, can I still do a SEP IRA on top of the 23K, which I do from my employer on my W-2 income?
So if you have a loss in your C corp or S corp, you have to have earned income to contribute. And I'm not sure if I caught if I understood that correctly. You have a current employer 401k and an S corp. Well, just to be clear, I don't know if he meant that. So just to be clear, if you're making contributions to your employer's 401k and you're trying to open up forgive me, a solo 401k to also make contributions, you can't. The limitations are still the same. The contribution limits are still going to be $23,000 between the both. So you can't put $23,000 in your employers and another 23,000. It's amongst all your solo 401ks. Same thing for IRAs. You could have 50 IRAs. It doesn't mean you could contribute $7,000 to every single one of them.
Thank you for that. Pawan, do you have anything to add on to that question?
If I understood that correctly.
Yeah, if not, we can move on to Joseph and Rachel. Joseph's question is, what's the difference between a solo 401k versus a SEP IRA
Great
with
question.
regards to taxes?
Great question. Taxes are still the
They are
same.
attorneys, I believe so.
Oh, it's great. So solo 401k and a SEP IRA, the rules still apply the same. A SEP IRA, which stands for Simplified Employee Pension, okay? You still have to be the sole proprietor of an LLC, C Corp, or S Corp, same concept, but you could still make a contribution of 25% of your net earnings up to 69,000. So sometimes I think that the SEP IRA, because the contribution limits are the same as the solo 401k, and it's cheaper than the solo 401k. Okay. However, you will still trigger UBIT. So if you're planning on leveraging and that's your goal and that's what you're trying to accomplish, I would put you inside the solo 401k before I put you inside the SEP IRA. So the contribution limits are the same. This is still cheaper. You still have to be the sole owner, right? An LLC, C Corp, or S Corp. You could also add your wife to it. But the only thing is you can't make a contribution of $23,000 is what I'm trying to say with inside the SEP. It has to be 25% of your net earnings. So if you're making $200,000 within the S Corp or C Corp, you could put $50,000 or up to 69,000.
Okay. I hope that answers the question for Joseph
Yes,
and
it does. Thank you.
You're welcome, Jeff.
awesome. If I'm understanding that right, if you do qualify for a solo 401k or a SEP, then I mean, so most people don't qualify for both, or do they? Could they potentially?
I'm sorry. I'm
If
denying somebody's trying to access your Zoom or my Zoom. I don't. I denied it. So just so
oh,
you know.
okay. I'm not seeing
Oh,
anything
okay.
on my end.
Okay. I just
But
denied it. So what was the
okay.
question? Forgive me, Priya.
No worries. Don't worry about it. I think we can always deep dive into certain things separately. But I think if Rachel and Joseph have a question answered, we should be fine. I think
And Joe, I was gonna say, Joe, Priya, I'm sorry, I didn't mean to cut you off. Joe, if you want to personally, like, if you go to iraclub.com.
they're working with you they're getting into for one of our syndication opportunities. So they're
Oh,
already your
great. Okay.
clients, I
Great,
believe.
Joe. All right. Awesome.
Right,
Great. Yeah.
right. Yep.
Thanks, Joe. If you need to schedule a call for further clarification, feel free to do so.
Okay. Yeah, no, I currently have a SEP, but it seemed like from what you were saying earlier, the sole 401k was better, but you're
It
saying
is
that's only better if you wanting to leverage it.
leverage, correct.
And by leveraging it, you mean to use it
To
to borrow from it.
Exactly. So let me let me give you an example. Let's just say this is a house on 123 Green Street. Okay.
Hmm.
Let's say it's valued at 200,000. Your IRA has only got I'm sorry, your solo 401k only has $100,000. So which means you have to go borrow the rest from the bank. That's when you're
Hmm.
leveraging. Okay. But if you
Hmm.
leverage inside a solo 401k, you do not trigger UBIT. If you do it within the SEP IRA, you will trigger UBIT.
So
Gotcha.
this also applies to when you're using your capital to invest in syndications. Correct me if I'm
Correct.
wrong, Ramez.
Yes, you are correct.
Okay.
Gotcha. So if I were to use the money in my currently that's in my SEP, I would need to roll it over into like a sole
Solo 401k.
401k.
So yeah, if you want me to step you yes, you can. So that's what's great about this is if you have a SEP IRA and you would like me
Hmm.
for me to establish a solo 401k, I can and move the money from the SEP to the solo 401k because you want to leverage. So
Gotcha.
you don't trigger
Okay.
UBIT.
Gotcha. And typically, I might have already answered this. I joined a little bit late, but how much is UBIT typically, like 10%
No.
or?
So because you're an IRA Club client, okay, go to iraclub.com, and underneath on the top side, there's a resource center. Go to guides, hit guides, and about the 6th or 7th one down, it says how to calculate UBIT.
Okay.
And it'll show you the actual breakdown of the cost of how much the UBIT tax is per bracket, depending on how much money you're making.
Gotcha.
And I'm telling you, it's
Okay.
pretty hefty, Joe.
I can imagine. Thank you.
You're welcome, Joe.
I think we'll wrap it up with this last question. Ramez, the question is, can you please tell me one more time about UBIT taxes? Oh, I think, did we just cover it if we invest in syndications from IRA? We just talked about that,
Yes.
right?
Yeah. Yep.
Yeah. And I
Can
think
I
what
ask one question if it's
sorry,
okay?
go ahead. Mm-hmm.
So the question is, if you have a short-term rental and you are generating positive cash flow, say you are generating like $40,000 in a year with short-term rental, and when you do the tax filing, you kind of do the depreciation. So overall, from the tax perspective, like you are in a paper loss, but the actual positive cash flow you generated is like 46,000. In that case, is it okay to open up a solo 401k since you are having a positive cash flow, even though from the tax perspective, you will do depreciation, kind of get it as a negative one?
So I think I think you touched upon this, Ramez. Do you want to?
No, go ahead, Graham.
So
Some of it got caught off in the middle, but if you heard it, you could answer it, and I'll filter in. I'll jump in.
So Pavan, you're talking about having a short-term rental through your solo 401k and investing in a short-term rental using leverage through your 401k to purchase a short-term rental, correct?
It's the other way.
Through your solo 401k or outside of the retirement account?
So you are having a solo 401k under LLC and generating like 40 grand cash flow, and you're trying to set up a solo 401k for this positive cash flow you have. So the question is, from tax perspective, you'll use depreciation. So you will not have this positive cash flow when you file taxes.
Yeah.
The question is, can you have this solo 401k set up from the positive cash flow you have from the short-term rental?
Oh, so he's
talking about the STR being outside of it in an LLC and then using that business to create a solo 401k. But on paper, if you're negative, then you're negative. I believe if his...
Yeah, I was about to say on paper, if you're negative, you can't because it
Yeah.
has to be earned income. But
Sure.
if you would like to schedule a call with somebody from my compliance team, and you
Sure.
could sit down and ask that question, I recommend that you do that or reach out to your CPA because your CPA will tell you yes or no.
Sure.
Sounds good. Thank you so much, Ramez. This was so much fun. I've learned so much, which I think you're
Thank you.
breaking up a little bit. I'm hoping you can still hear us, but yeah. And thank you for staying a little late. We really appreciate everything you do for the community, Ramez.
And thank you for having me. And again, just final remarks. We're just here at the end of the day to just open up doors and opportunities for everybody. That's it. And we're just here to help walk you through that process. Thank you for the heart, whoever that was.
That's Puvan. Thank you, everyone. Thank you for
Thank
staying
you.
late on a Thursday. Everyone have a great weekend, and then we'll have another podcast on Thursday, and I'll see everyone then.
Thank you.
Take care, guys.
Bye-bye.
Take care, Ramez.
Take care, you.